Okay, let's unpack this. Today we're taking a deep dive into Citigroup's second quarter 2025 earnings call and also their supplemental financial tables.
Yeah, there's a lot there.
There is. Our mission, as always, is to really go beyond just the raw numbers, and extract the most important nuggets of knowledge, insights, offer you a shortcut to being truly well-informed about one of the world's financial giants.
Makes sense.
We're going to explore everything from their overall financial health, how their key businesses performed, their longer-term strategy, and even their, well, pretty interesting take on digital assets.
Definitely worth watching that space.
So what does this quarter really reveal about, the evolving landscape of global finance? What jumps out first?
Well, looking right at the top line figures, it's pretty clear from the start that Citi's on a strong path. They reported net income of $4 billion for the quarter.
$4 billion. Yep.
Yeah, and earnings per share at $1.96. Their return on tangible common equity, or ROTCE, that hit 8.7%.
8.7%. Now that's a key metric, right?
Absolutely. And, that 8.7% isn't just a number. It tells us how efficiently Citi is using its shareholders' money to generate profit. It's a solid improvement, definitely above prior quarters. But it also shows they still have, some room to grow towards those longer-term targets. So maybe some upside potential still there.
Right. It's not just hitting a number, but the story those numbers tell about their operational health. Yeah.
Exactly.
And that 8% firm-wide revenue growth, hitting $21.7 billion.
Yeah.
That really anchors that story of disciplined growth.
It does. It's significant.
What's really striking to me is that 3 out of their 5 businesses actually hit record second quarter revenues. 3 out of 5.
That's quite something. Shows breadth.
Yeah, and they highlighted positive operating leverage across all the individual businesses and at the group level. Now, for you listening, positive operating leverage is kind of like getting more bang for your buck, right?
That's a good way to put it.
It means their revenues are growing faster than their expenses, which, signals really disciplined management, a healthy financial machine working.
Very healthy sign.
The company even stated they were, and I quote, ready to lean in despite the lack of clarity of the moment. That sounds pretty confident, almost aggressive.
That phrase, lean in, yeah, it is quite telling. It suggests a strategic willingness to push forward, not just sit back. And that becomes even clearer, I think, when we dig into the individual businesses.
Okay, let's do it. Starting with what they've consistently called their crown jewel services.
Ah, yes. Services. Always a strong performer.
This business alone delivered an ROTCE of 23% for the quarter. 23%.
Yeah.
And even higher year-to-date, 24.7%. That's, truly remarkable consistency for such a core part of their business.
Absolutely. Its revenue was up 8%, which is robust growth. And it was driven by pretty significant increases in both loans, up 15%, and deposits, which were up 7%.
15% loan growth there, wow.
Yeah, but it's the underlying fee drivers that really stand out to me. Things like cross-border activity that grew by 9% year over year, U.S. dollar clearing volume increased by 6%, all contributing to total fee revenue growth of 6%.
So these are signs of just how deeply they're plugged into global trade and commerce, right?
I agree. Deep integration.
And their assets under custody and administration, AUCA, soared to over $28 trillion.
Trillion. It's hard to even grasp that number.
It really is. To put that $28 trillion into perspective, it's not just big. It shows Citi's massive scale, how deeply embedded they are in the whole financial ecosystem, kind of like a crucial backbone for other institutions.
A utility, almost.
Yeah. And that 17% increase year over year isn't just growth. It reflects, increased trust and activity among their big institutional clients.
And they mentioned strong client engagement, too, onboarding almost 2,000 new suppliers just this quarter. New client wins up 24% year over year, apparently driven by corporates building up inventory.
Paints a picture of a business really firing on all cylinders and expanding its reach.
It does. So beyond that foundational services segment, let's maybe pivot to markets. That's often the barometer, for broader financial activity.
Okay, markets. How did they do?
They really shone. Best second quarter since 2020, revenues up 16%.
16%. Okay. That's strong.
Very strong. Fixed income revenues alone rose by 20%, particularly in rates and currencies. That was up 27%, mainly due to increased client activity, hedging strategies, that sort of thing.
That's a significant jump. And equities. I heard good things there, too.
Yeah. Equities had their best second quarter ever, according to them. Prime balances hit a record, growing around 27%.
Wow.
Overall, equities revenues were up 6%, but And this is interesting, if you exclude the impact of a Visa B exchange offer from last year, that number jumps to over 35%.
35% underlying growth, basically. That's huge. And they pointed to improving market sentiment as a key factor.
They did.
So what do these specific growth areas like rates and currencies and fixed income or prime balances and equities? What does that tell us about where Citi is strategically placing its bets in this, shifting market?
Well, what's fascinating here, I think, is how they're capitalizing on both volatility. You see that in rates and currencies and rising client activity. Prime balances and equities, that speaks to a growing appetite for sophisticated trading and financing services among their institutional clients.
Right.
It really shows them gaining traction in those high return areas, not just playing defense.
Okay, makes sense. Next up, banking. They seem to be right in the middle of some massive high-profile deals.
Yeah, banking revenues surged by 18%. Big jump.
18%. And they mentioned being the exclusive advisor to Boeing on an $11 billion sale, lead advisor to Nippon Steel on that $15 billion acquisition of U.S. Steel. These aren't small deals.
Not at all. And through the first half of this year, 2025, Citi was apparently involved in 7 of the top 10 investment banking fee events.
7 out of 10. That's dominance.
It shows real market presence. And what's even more striking is how they're not just participating, but actively gaining ground in specific high-value niches. For instance, they saw incredible M&A momentum, up 52%.
52%.
Yeah. And notably gained share in complex areas like leveraged finance, lending money for big corporate takeovers, and in equity capital markets, particularly fueled by convertibles. These are all areas that demand really sophisticated expertise and, frankly, generate significant fees.
Right, high-margin business. Okay, what about wealth? That's been a focus area for them.
Wealth also delivered significant growth. They hit a pre-tax margin of 29%, with revenues up 20%.
20% revenue growth, 29% margin. Pretty healthy.
Very healthy. Each line of business saw substantial growth, and non-interest revenue was up 17%. Now, they did see a bit of a slowdown in inflows this specific quarter, mainly due to that broader macro uncertainty we're all feeling.
Okay, that makes sense. People getting cautious.
Exactly, but they still achieved 9% organic growth in net new investment assets over the last year. So the trend is still positive, and they anticipate a pickup as, markets hopefully recover.
So that slowdown this quarter, does it suggest just general cautiousness among affluent clients right now? Or something specific to Citi?
I think it reflects more of a natural pause. When markets get choppy, even wealthy individuals tend to, sit on the sidelines for a bit. But that continued organic growth over the year, despite this quarter, it indicates underlying client stickiness and trust. It's about long-term asset gathering, which remains strong.
Okay. They also mentioned a new partnership with iCapital. That's for alternative investments, right?
Correct. It'll provide an end-to-end solution for their alternative investment offerings in wealth. It's a smart move, I think, for catering to those high net worth clients, giving them easier access to less conventional, potentially higher return investments.
Yeah, alts are definitely a focus for that client segment. Okay, and finally, the fifth business. U.S. personal banking, USPB. How did that fare?
USPB saw revenues grow by 6%. Branded cards showed significant strength. Revenue up 11%, interest earning balances up 7%, and spend volume up 4%. Pretty solid numbers there.
Solid, yeah.
Retail services did face some pressure, though, mainly from lower partner sales activity, which isn't entirely unexpected given some broader shifts in consumer spending.
Right, maybe some pullback there.
Possibly. However, retail banking itself had a strong quarter, supported by improving deposit spreads. Its revenue was up 16%.
16% in retail banking. Nice.
Yeah. And management expressed confidence in the quality and mix of their portfolio and in their reserve levels being healthy, which suggests, they're not seeing major credit deterioration in their core consumer base, despite some headlines out there.
Good to hear. And they're not standing still in USPB either, are they? Mentioned a new premium credit card.
That's right. They're planning to launch a new proprietary premium card, the Citi Strata Elite, later this quarter, aimed at expanding their offerings for more affluent customers.
Makes sense. Ties into that strategy of focusing on higher value clients across the bank.
Okay, so with all this strong performance across the board, how does it translate into their capital management, credit quality, and maybe expense discipline? Let's start with capital.
Sure. So capital management, they returned over $3 billion to common shareholders just this quarter. That included $2 billion in share repurchases.
$2 billion in buybacks.
Yeah. And year to date, they've repurchased $3.75 billion in shares. That's part of a larger, previously announced $20 billion repurchase plan.
So they're executing on that plan.
Definitely. They ended the quarter with a preliminary Common Equity Tier 1, or CET1, capital ratio of 13.5%. Now, that's 140 basis points above their current regulatory requirement.
That's a pretty big buffer. What does that signify?
Well, this significant buffer isn't just about ticking a regulatory box. It gives Citi considerable strategic flexibility. Maybe allows for more aggressive share buybacks down the line, potentially larger dividends, or even, opportunistic acquisitions if something comes up. Right options. And they seem pretty pleased with their recent stress test results, too.
Very pleased. They said it positions them to continue increasing capital returns, both through those buybacks we mentioned and an increased dividend. They're bumping it up to $0.60 per share starting in Q3.
60 cents. Okay. And this all ties into their broader strategy of de-risking the company, right?
Yeah,
Making it more focused.
exactly. Implementing a more focused business model, divesting those international consumer businesses. Poland, they said, is the last remaining sale, expected to close sometime next year.
So it's a very deliberate move towards a leaner, more focused bank, isn't it? Concentrating their efforts.
Precisely. It's about shedding non-core assets to become, hopefully, a more efficient global giant,
Yeah.
focusing capital and resources on areas where they feel they have a distinct competitive advantage.
Okay. What about credit quality within that leaner bank? How are the reserves looking?
Credit quality looks pretty stable. Their total reserves stood at $23.7 billion. That gives them a reserve-to-funded loan ratio of 2.7%.
2.7%. How does that break down?
Well, it's noteworthy that about 85% of their card portfolio is with consumers who have FICO scores of 660 or higher. Pretty prime.
Mostly good credit scores, then.
Yeah. And the reserve-to-funded loan ratio, specifically in the card portfolio, was 8%. They even noted an improvement in card credit trends this quarter, which is, a positive sign against some of the broader economic chatter about consumer health.
Interesting. An improvement. And on the corporate side?
Corporate exposure, about 80% is investment grade. So, again, a strong indicator of portfolio health and relatively lower risk there.
Okay. Now, the flip side, expenses. How are they managing costs amidst all this growth and investment?
Well, total operating expenses were up 2% compared to Q2 last year.
Only 2%. Given the revenue growth, that sounds like that positive operating leverage you mentioned earlier.
It does point to that. Now, the increase was mainly due to higher compensation and benefits that include some severance costs from tech workforce realignments they've been doing.
The restructuring costs.
Right. Also, volume-related expenses, more business means some costs go up. And continued investments in transformation and technology, they're still spending heavily there.
But offset by some things.
Yeah, these increases were partially offset by lower tax and deposit insurance costs, and also the absence of some civil money penalties they had in the prior year quarter.
Got it. So those transformation costs are still significant now, but what's the outlook there?
That's the key forward-looking point. The bank anticipates those transformation expenses will start to decrease next year as these big programs reach their target state, and automation, including AI tools they're deploying, should streamline efforts.
So heavy investment now, but expecting efficiency gains soon.
That seems to be the plan, which is obviously critical for their future profitability path.
Absolutely. Speaking of forward-looking, what's their outlook and strategic vision beyond, say, the rest of 2025?
Yeah,
It sounds like they're building some real momentum.
they certainly seem to think so. Given that strong first-half performance, Citi now expects full-year revenue to be at the higher end of their previous range, so around $84 billion.
$84 billion for the full year. Okay.
Yeah, with net interest income excluding markets up closer to 4%. Expenses, they're projecting around $53.4 billion. But they did add a caveat potential for increases there if revenues beat expectations even further.
So keeping an eye on costs, but prioritizing revenue capture. Makes sense. What about credit losses going forward?
For credit, they expect net credit losses for branded cards to be within a range of 3.5% to 4%. For retail services, a bit higher, 5.75% to 6.25%. They say this reflects those improved delinquency and net credit loss rates they're seeing currently.
Okay. Sticking to their guidance there. In capital returns, more buybacks.
Definitely. They remain committed to repurchasing shares, with at least $4 billion expected just this quarter, Q3.
$4 billion this quarter. That's a strong signal.
It really is. This consistent commitment to buybacks, it speaks volumes about their confidence in their capital generation and their view on the stock's value.
Looking further out beyond 2025, they mentioned their ROTCE target for next year, that 10-11% range. But they called it a waypoint, not a destination. What does that imply?
Yeah, I like that phrase. Waypoint, not a destination. It's a powerful metaphor, isn't it? It indicates a focus on continuous improvement in returns, not just hitting one static goal and stopping. They're signaling ambition beyond that 10–11%.
So how do they get there? What are the drivers?
They laid out three key drivers for those longer-term returns. 1, revenue growth. 2, expense discipline. And 3, capital efficiency. Pretty standard pillars, but the details matter.
Okay, so break down revenue growth for us. Where do they see coming from?
They're looking at continued share growth in banking, fueled by that strong M&A pipeline we talked about, sustained growth in services, driven by adding new clients and product innovations, and they specifically mentioned digital assets here.
Ah, interesting. We'll come back to that.
Oh, yeah. Significant upside potential they see in wealth, continued investment in prime services within markets, hoping to leverage expected volatility, and USPB benefiting from those new product innovations like the Strata Elite Card and partnerships.
So really leaning into their strongest segments and innovating.
Pretty much. Then, number 2, expense discipline. Future reductions here are expected to come from a few places. Lower severance costs as restructuring tails off, decreasing transformation expenses, which they specifically guided towards starting in 2026.
2026 for transformation costs to really come down.
Yeah. Further reduction of what they call stranded costs from the divestitures, about $1.2 billion still remaining there, and increased productivity, partly enabled by AI, as we mentioned.
So this isn't just wishful thinking on expenses. It's tied to specific actions and investments winding down or bearing fruit.
That's the argument, yes. And finally, number 3, capital efficiency. This is about continuing the efficient use of risk-weighted assets and capital, basically doing more with less capital where possible, and that's demonstrated by those ongoing share buybacks.
Makes sense. Revenue up, expenses down or flat, use capital wisely. The classic formula.
Exactly. But the execution is key, of course.
Now, let's circle back to something you mentioned under revenue growth drivers, digital assets, and stablecoins. This feels like a really forward-looking area where traditional banking meets the future. What's Citi's take here?
Yeah, this was quite prominent in their discussion. They see digital assets as the next evolution in payments, financing, and liquidity. Not just a niche thing, but fundamental.
The next evolution. Strong words.
Very. And they're backing it up. Their Citi Token Services platform is already live in 4 major markets, and they said it's processed billions of dollars already. So this isn't theoretical. It's real-world application happening now.
Billions processed. Okay. What are they exploring specifically?
Well, they're actively looking into reserve management for stablecoins, creating on and off ramps between traditional cash and digital coins, potentially issuing their own Citi stablecoin.
Citi stablecoin.
Wow. Tokenized deposits, and even custodial solutions for crypto assets. They view this whole space as a significant opportunity to modernize their own infrastructure, grow new revenue streams, and importantly, acquire new types of clients.
But are they being cautious? It's a risky area, too.
Oh, absolutely. They emphasized a safe and sound approach. That includes building out robust compliance, accounting, and anti-money laundering solutions specifically for these digital assets. This isn't the Wild West approach. It's about building a regulated, compliant framework for these new technologies within a traditional banking structure.
Bringing it into the mainstream, basically.
That seems to be the goal. And they even expressed enthusiasm for regulatory frameworks that provide a level playing field for banks in this space. They want clear rules so they can compete effectively.
Very interesting. So they're leaning in there, too. Okay, beyond the big picture strategy in these future-focused areas, what about some of the key questions or challenges they addressed during the earnings call itself? Any hurdles?
Sure. Regulatory capital and those stress tests were definitely a big topic. While they were pleased with the recent results in getting a reduced stress capital buffer, the SCB.
Which means they need to hold slightly less capital against potential stress, right?
Yeah, exactly. But they're still awaiting finalization of proposed new rules about how that SCB might vary in the future. And that uncertainty influences their future capital targets and overall flexibility.
So, good news now. But the long-term rules are still a bit up in the air.
Precisely. It adds a layer of uncertainty for long-term capital planning.
Okay. What about progress on those consent orders they've been operating under?
They reported significant strides on the transformation work tied to those orders. Many programs are apparently at or near target state in key areas like end-to-end risk management and compliance.
That sounds positive. Does that mean the orders might be lifted soon?
Well, crucially, they emphasize that the expense reductions they expect from this work don't actually require the consent order to be formally lifted. It's more about the work being done, validated internally and by regulators, and proven sustainable.
Ah, so the benefit comes from fixing the process, not just the official sign-off.
Exactly. It's about the operational progress they're making right now. The sign-off will come when it comes, but the efficiency gains can start sooner if the work is truly done.
Got it. What about the Banamex divestiture in Mexico? Any updates there?
Yeah, they said preparations for the IPO of Banamex are right on schedule. They expect to have the crucial audited financial statements ready later this quarter.
Audited financials are key for an IPO.
Absolutely. Now, the big picture here is getting Banamex ready for that IPO, ideally by year-end, though they acknowledge timing is subject to market conditions and regulatory approvals, so it could potentially slide into 2026.
Understandable market dependency there.
Right. But getting this done is a huge step in Citi's broader strategy to streamline operations and focus on core strengths, shedding non-core assets, becoming leaner. They also noted, by the way, that Banamex itself is performing well, outpacing market growth in Mexico with double-digit consumer business growth.
So they're trying to IPO a healthy growing business, not just dump an asset.
That seems to be the aim, yeah.
Yeah.
Makes the divestiture potentially more valuable, too.
Okay. Did they talk more about consumer credit trends? We touched on the improvement in card metrics.
They did. They noted that the improvement in credit card delinquency and net credit loss rates seems to align with pre-COVID seasonality, suggesting maybe a return to more typical credit patterns after the pandemic distortions.
That's normal-ish.
Perhaps. Management feels confident in their guidance for net credit losses based on these trends. They also observe that spend volume increases are mainly coming from their more affluent customers, primarily on essentials, dining, and entertainment.
So the higher-end consumer is still spending.
Seems that way, indicating a resilient segment within their consumer base.
What about growth opportunities in investment banking and markets? Are they still looking to expand there?
Yes, they see good opportunities to add, particularly in areas like prime services, which caters to hedge funds, private capital, and financing solutions. They think they can leverage their existing scaled platforms here for pretty high marginal returns.
Makes sense. Build on existing strengths.
Yeah. The bank emphasized a disciplined allocation of its balance sheet, though, trying to achieve the full share of wallet from key clients, but also actively moving capital away from areas they see as low return or becoming commoditized.
Strategic allocation, not just growth for growth's sake.
Exactly. Ensuring capital is deployed where it can generate the most value.
And finally, what about USPB's path to higher returns? You mentioned the new card, but what's the overall plan to boost profitability there?
A goal for USPB's ROTCE, they said, is to eventually reach the mid to high teens.
Mid to high teens. That's a significant jump from where it likely is now.
It is. The drivers are expected to be, again, revenue expansion through new products like the card, better digital capabilities, improving expenses as those transformation costs finally decrease, and better capital efficiency.
Same themes as the group level.
Pretty much. And the retail banking strategy, with its focus on high deposits per branch and its role as a feeder for the wealth business, is also a key component of this path. It shows a more cohesive strategy connecting the different parts of USPB.
Okay, that paints a pretty comprehensive picture. So, pulling it all together, what does this all mean for the future of banking, looking beyond just Citi?
Well, as we've seen from this deep dive into Citi's Q2 2025 earnings, the banking landscape is definitely evolving rapidly. You have these traditional strengths, but they're being driven now by new technologies, too.
Right. Citi's strong performance, those strategic divestitures focusing the business, their commitment to innovation, especially in digital assets like stablecoins,
Yeah.
it suggests a very proactive approach to what's clearly a dynamic environment.
Proactive is the word. They're not waiting to react.
So, maybe the final thought here is, how might a major bank's willingness to, as they put it, lean in during times of uncertainty by actively modernizing infrastructure, embracing new financial technologies like tokenization, how might that redefine what it means to be a global financial leader in the years to come? Could this proactive stance set a new standard for the rest of the industry?
It's a fascinating question. If they succeed, it could certainly pressure competitors to accelerate their own transformations, couldn't it? Lot to watch.